Cool. AJ, you want to walk us through the agenda and then?
Sure thing. Welcome everyone to Changing Your Tax Residency, a webinar presented by Brooklyn FI Tax. A lot of you registered are clients, so I know most of you pretty well. Most of you know Shane. Most of you have probably not met Emily yet. She joined our team back in June. She's our tax manager. We're super excited to have her. And she's going to be presenting along with Shane today. A little bit of housekeeping. If you have any questions while they're talking, please use the Q&A, and I'll be saving those questions. We're going to open the floor up to answer those questions once Shane and Emily get through the presentation. But today we're going to cover defining what it means to be a New York State or New York City tax resident. We're going to spend a lot of time on that. We'll talk about income sourcing, tax withholding, and tax credits. What if you did move out of New York City? How to establish tax residency in a new place? A lot of you had questions about remote work, right? It's COVID time, so most of us are not working in offices right now. What is deductible, right? If you're now working from home and you bought a standing desk and some new monitors, can you deduct those expenses? Probably not. We'll talk about why. And then there is some new funky, or not new, but just some funky laws to watch out for. They're called it is called the convenience rule. So we'll get into that if you have moved states, mostly within the Northeast. So a lot of content today. Hopefully a lot of it is actually applicable to your lives. We love tax law. You don't love tax law. We're going to do our best to explain it to you in the best way possible.
For sure. And, a lot of these rules are targeted at the rules or the laws surrounding New York State and New York City. And each state is different, but they're all very similar. So it might not be exactly the same. It might not repeat itself, but it'll rhyme for your state. We're going to try to bring up some other states that California we'll try to bring up a little bit as we move through this. But most states are pretty similar. So we're going to talk about the principles of state tax residency with a focus on New York. This is Brooklyn FI after all, but we do have clients and employees all over the country now. So if you're looking for specific rules surrounding your state or city, please put it in the chat. If we can't answer it at the Q&A at the end, we'll try to follow up later if you're a client. If not, it might be a good idea to become a client. So yeah, I think AJ already introduced us. But here's some lovely shots of us under the what is this, the Williamsburg Bridge?
Williamsburg Bridge. Yeah, Shane's going to start talking, but I'm going to throw a poll out to the audience, and I'm going to be throwing out some polls throughout this. So that's a new feature we're testing out. It's going to be fun. So cool. Please answer. They'll be anonymous, so it's more for just curiosity.
Excellent. Yeah, Emily's I've never met Emily in person. So unfortunately, we didn't get a shot of her underneath the Williamsburg Bridge. AJ has had the opportunity to meet Emily in person, but this is the newest member of our team. She's the newest tax manager. We're really excited to have her. A lot of great experience under her belt. So what's at stake here? What are we looking at here? Let's hop into the meat of the content. How high are income tax rates in your state? We've got a lovely little chart from the Tax Foundation. For those of you that are looking to transfer to new states, here's what is at stake. We've got a little color scale. Unsurprisingly, New York and New Jersey tend to be on the higher end for marginal tax rates. These are just marginal tax rates. For those of you that know the difference between marginal and effective tax rates, this is a good symptom of the effective tax rate in that state as well. So no surprise, on the coast, we're a little bit darker than in the middle of the country. Oregon and California coming in quite high. Some of you are looking at New York and saying, wow, that's a lot lower than California. This doesn't include New York City tax rates, which are about 3 to 4% on top of this 8. So that is what's at stake if you're moving out of the city to upstate, is about 3% of your income. And a nice surprising high marginal tax rate here in Minnesota. I wonder if that is based on like incomes over $1 million or something, and it's like 6% for everyone else. But who knows? One of the other great takeaways from this chart is that there are some lighter, burnt copper colors for your more average normal tax rates of 5, 6, 7%. And then there are some gray states in here, right? What are these gray states? These are the states that have no income tax, right? So most notably, Texas is one of the states that has no income tax. We get a lot of renegade or refugees from California and New York. I used to live in Austin, and there were a lot of states, there were a lot of bumper stickers that said, go back to California that were there, or don't California up my Texas, or all that fun stuff. Washington, Nevada, Wyoming, South Dakota, Florida, New Hampshire has an asterisk, so does Tennessee. These are also no income tax states in my mind. The asterisk essentially says that they do tax interest and dividends. How much of you guys are really worried about your tax on your interest and dividends? Too much? Not much. So we can include them in the non-income tax states. Tennessee is the most recent joiner of this group, this cohort of no income tax states. So welcome aboard, Tennessee. So if you're trying to move from New York or California into one of these other states, here's what's that state. Okay. Now let's start getting into some of the important definitions for residency for tax purposes. Okay. So there are two main definitions and two main tests that we need to work, that we need to discuss here. And those definitions are going to determine where we pay income taxes. They determine some other things, such as for estate planning purposes, where your assets are going to be protected. Estate planning definitions. We're going to focus on income taxes today. And the main definitions are statutory resident, which is a quantitative test to determine where you are a tax resident. And then there is a domicile test, which is a more qualitative, subjective definition of where you are a resident for taxation purposes. So again, quantitative means math, right? So if you spend a certain amount of days here, it's easy to add those days up. It is a bright line rule about a determination of where you are a resident. And then there is a qualitative test, which is subjective, right? So in a courtroom, if you were ever audited to determine where you were for a domicile test, you would be laying out a story, right? You'd be telling a subjective story about where you intended to live and where you were moving. And a lot of us are probably not going to trigger a quantitative test this year in terms of moving across state lines, but the state of New York or whatever state that you're trying to get away from might apply a qualitative test. And where was your intent to live for the year? Like you might have gone to Montauk for 6 months, but is your intent really to come back to the city, or you might have moved to Nevada or Arizona for 6 months, you might have gone back to your parents' house, you might have gone to some other family's house, grandparents' house, what have you. But if your intent was always to move back to your original state, then that state is going to claim that you are a domiciliary of that state, and thus you should be paying income taxes to that state, even if you were working elsewhere. Now we're going to take a look at the state of New York's definitions of residence, because these are going to tell us what those definitions are. Each state has a different definition. They're going to be similar to New York's. So we're going to see those two tests at play here. You are a resident of New York State if your domicile is New York State. Okay, so it's a domiciliary test. There's more to it than that. Or on the statutory resident side, they don't actually say that here, but this is the test at stake here. If your permanent place of abode, your house, is in New York State for substantially all the tax year, and you spend 184 days here. 184 times 2 is 365-ish. So essentially, if you spent half the year in New York and you have a place there, then you have triggered the quantitative side of that test. Okay. So those are the two things for the state of New York and how they define it. The definition of a permanent place of abode gets fun. We're going to talk about that in a second. And now some of you are wondering, all right, I just moved upstate, so I know that I'm a New York State resident. How do I get away from the city, right? That 3%, 4% tax on high incomes. To apply these rules for the state, for the city, you just replace the word New York State with the word city. So they've actually made it pretty easy for us. Just replace the word state with the word city, and the rules are the same there, okay? So you're going to want to get away from your domiciliary situation or your statutory resident situation for the city as well. So let's dig into these words a little bit more in depth. Now, domicile. So the state of New York defines the word domicile as the place you intend to have as your permanent home, or where your permanent home is located. Some people have two homes. We're going to get into that in a bit. At the end of the day, it's the place where you intend to return to after being away. Some of us have been away from our permanent homes for some time now, as in like we've been on vacation, been on virus vacation. If you intend to return to the city, then the city of New York is going to try to tax your income. We're going to talk about the mechanics of establishing residency later with tax returns. But we expect a lot of notices from the city of New York and the state of New York to all of our high income earners that have filed part year tax returns or non-resident tax returns for the state for the year of 2020. We expect a huge flurry of residency audits because the states often are the first ones to lose revenue and to get desperate to generate revenue during recessions. We saw that in the 2008 crisis. The states got really aggressive about tax revenue because they don't have a treasury like the federal government does, where they can just print more money and not have to worry about their budget as much. They will have to go after people to get that money. I said that we were going to get into now. Yeah, before I move on, I said domicile and statutory resident. At the end of the day, you can only have one domicile. Okay, you can have multiple residences. You can have a house in Chicago, a house in New York, and a house in Florida, but you can only have one domicile. Okay, so that's a concept we need to keep in mind as we move through the rest of these principles throughout the rest of this presentation, because you can only have one. Okay. Now, permanent place of abode gets fun, like I said before, because some people have argued that their cabin in the woods was their permanent place of abode, even though it didn't have a sink in it. And you can dig through the legislative history and get some nice opinions from judges. It's one of those kinks. So one of the fun things about working in tax law, but we don't have time for it right now. We've got time for clip art, but we don't have time for AJ. I think added some clip art for us.
What?
Right on. It's cool. So now there are some exceptions to the domicile rule. Okay, so just to back up a little bit, if your intent is to stay in New York, or if according to this this rule where you have an apartment and you spent more than 184 days in New York or a house in New York, then according to the law, you just triggered a math test and you are a resident of New York for that year. Okay, or if you, and then the other thing, which is a little bit muddier, is the domicile. Okay, so we'll come back to that later. There are exceptions to this. Even if you have a domicile in New York and you meet all of the conditions here, you are not a New York resident. And these are intended to allow people to come work in New York and get away from New York residency. If you do not maintain a permanent place of abode during the year and you maintain a permanent place of abode outside New York and you spent less than 30 days in New York, you don't have to worry about it. So that's one way to get you off the hook. That's Group A. Group B is for our international, it's kind of a special carve out for the wealthy. Kind of feels like that international wealthy elites. If you, even if you maintain a place in New York and you spend 450 days during any 548 consecutive day period, which gets to scale, and you spend those days outside the country, you can maintain a place in New York, but you spend most of your time outside the country. Good for you. Then you can avoid residency. I spent too much time in my life figuring this out for international elites, but it was good professional experience. All right, so now what we kind of want to do with this slide is just kind of summarize what's going on with the residency in general. Is that you can move to another state and you will still be filing in your old state. Is a thing that can happen. Okay, so what we want to focus on here is that there's what's called the leave and land rule, wherein if you leave your original state, you might think that, hey, I don't need to file any taxes in New York anymore because I left, or insert whatever state here. But if you do not land somewhere else, then your original state is going to hold on to you like a bad ex. Okay, so I'm going to use you did not just break up with your ex here, you also need to have a new significant other. All right, that's how you establish domiciliary in a new state. We're going to talk about some of the ways that you can prove that you broke up with your ex, which might seem easy. You also need to establish a new relationship, okay, with the new state. We're going to talk about some of the boxes you can check in order to prove that. Okay, if you have been living in an RV for 6 months, or if you have been bouncing around Airbnbs, AJ, for 6 months, or friends' houses or what have you, you have not landed anywhere else. Therefore, it appears that your intent is to come home. There was a famous, when we go through, when we're teaching our other accountants at the firm, there is a couple that left New York and were living in an RV for 3 years and didn't file any New York State tax returns, and all their passive income from retirement, they were not paying any New York taxes on it. They got audited and they owed like $150,000 or something to the state of New York because they could not prove they had landed in any other states. So that is the rule that we review, or the case study we review when we talk about this. Okay, now I told you we would talk about how to establish residency in a new place. Mechanically, it happens with a tax return, okay? There's not some office you walk down to and you say, I'm a resident now, and it changes your tax residency. There are things you can do that help with that argument, but when you are actually making a claim that you are not a resident of a certain place, you do that with a tax return, okay? So on a tax return, you actually put the dates that you moved from one place to another, and then with your accountant or yourself, if you're brave, you allocate your income between the two states. Okay, you allocate your withholding between the two states and your income between the two states, and that shakes out how much tax that you pay between those two states. Okay, so referring to the leave and land rule, here it is written down in case you guys didn't hear me before, it wasn't clear. So when we're looking at how to establish residency in a new state, the best way to look at what we need to do is to look at what the auditors do when they audit us, right? So we just look at the test that we're going to be taking one day, and we make sure that we study for that test and we get the answers right when we are prepared to take that test, which is an audit one day, right? So the rules surrounding statutory residency are pretty easy. We're going to talk about domicile in a bit. The statutory residency is don't have a place here and don't live here for 184 days if you're trying to cut ties with New York, whatever state that you're trying to cut ties with. Some states have as few as 30 days. Some states give you 200 days is the amount of time you need to spend there before you're a statutory resident there. Now, coming back to the domicile thing, what are the tests to establish domicile? So these are subjective things, right, that are going to be looked at by an auditor. There's 5 of them when trying to decide if you are a resident of New York, New York City, or whatever state that you're in, right? Well, I guess this is for New York, so, but they're pretty similar for other states as well. And the first one, and the second most important one, is where your home is and where your time is. So where your home is if you've got 2 homes, where do you spend the most time at? And where do you have the most things that are most near and dear to your heart at in either of those 2 homes, right? Like you've got an empty apartment in Hudson or whatever, and then you've got a place in the city where all of your diplomas are, your guitar is, your kids' toys are all there. Then even though you didn't spend, you spent 200 days upstate in Hudson, this could shift your domicile back to the city because your real true home, where all your nice things are back in the city. Okay, so you see how this subjective this is? You would need to be submitting to a judge in a courtroom all of the subjective elements of your life that prove that you have officially moved your life upstate. I talked about that dog before. There was a guy that moved to Dallas, and he was able to move his residency or his domicile to Texas. And the judge actually wrote in the opinion that he moved when his dog moved to Dallas, which I think we all know. Yeah, it's true.
There's an article in the chat if you want to see. It was actually the CEO of the Match Group of Match.com, I believe, who won that case.
But he works for him, apparently.
Yeah.
So good for him. So another element is where you spend the majority of your time, where your business is, right? Like even if I was to move to another state, our headquarters are in Brooklyn, so it would be harder for me to establish residency, domiciliary in another state. Same with AJ. And then we have where your family members are as well, where your significant other is, whatever's near and dear to you. So if your girlfriend or your boyfriend still lives in a place where you're trying to get away from, it's going to be harder to prove that you got away from it, etc. Okay, so Now, there are a number of things that you can do to prove that you have established residency in your new state or your new place. And there are a lot of things you can do, okay? Some of them are, we get these questions a lot. Some people think that just because they get a driver's license in a new state or what have you, or they're registered to vote in another state, that that's where they file their income tax returns. Or we get people that think they moved to New York City from Long Island and they try to claim they don't live in the city because their parents' place is in Long Island and that's where they've always filed. Like, that's just because you're registered to vote there doesn't mean that you're a domicile. The main things are your home, right, where you live at. But if there is murkiness, then here are the things that go into court to determine that help with the murkiness, such as where you register to vote, where you register a vehicle, where your car insurance is registered and moving across state lines. There's a fun one where you purchase a cemetery plot for our older retired folks or our great planning folks. Because you've got mail forwarding going from the old place to the new place. These are all things that add up to a story that you have moved, that help us with the story that, Your Honor, I have moved to this new place. I got a cemetery plot here. I mean, come on, this is where I plan on spending the rest of my soul's experience. All right, so those are some fun things. Now, that's how we establish residency. Now, mechanically, filing tax returns, we're going to get into some of the mechanics of that now. So since that's related to establishing residency elsewhere, we got to talk about income sourcing and the 3 types of tax returns. Okay, there's a resident tax return, which most people file most years. The year that they move from one state to another, they'll get used to a part year tax return. They should have 2, a part year return for the state they're moving from and a part year return for the state they're moving to. So on those returns, it'll say, I moved on March 31st and I arrived on April 1st. And they'll have those 2 returns. And then there is what's called a non-resident state tax return. And that is most relevant to people that have income from states that they don't live in, which is most commonly related to rental property for states that they used to live in, is what happens typically. So you moved out of New York, you moved to Colorado, you rented out your New York place while you were gone. You're a non-resident of that state is what you're claiming. Then you would have a non-resident tax return for the state of New York. Or if you've got a rental property in, say, Georgia from when you moved up here years ago, you're paying taxes to the state wherein you are generating income. Okay, so there's going to be a ton of part-year resident tax returns filed in 2021 for the year 2020 with everyone trying to break residency and move to new places. Okay, so that's how you break residency. And for tax purposes, that's how you claim that you have moved out, is you file part-year tax returns. Okay, now one of the biggest mistakes a lot of people make is that they don't even file a part-year resident tax return, they just file a full-year Connecticut tax return. So in 2019, they had a full-year New York return. In 2020, they have a full-year Connecticut tax return. And for that to make sense, that means that you would have moved on January 1st. So I'm sure occasionally people pack up all their things on December 31st and move on January 1st. But I imagine it doesn't happen quite as often as people file their tax returns to reflect that. So one thing that would help you with an audit is not doing that, because if you are audited and they say, well, it says here that you claim that you moved on January 1st, is that true? And you say, well, actually, we moved on February 1st, but we just wanted to make it clean for that 1 month, so we just filed full year resident. Then you've thrown your word under the bus, and now anything other claims that you put forward to that auditor are going to have a little bit of salt attached to them because you've already lied to them with your first immediate claim. So when we're talking about domicile, let's see, where are we here? You always need to file your tax return in the state that you are domiciled. So if you know that you are returning to New York in, say, January of 2021, then, or December of 2020, then you need to allocate all of your income to the state of New York for this year. And we don't need to update withholding. We need to file our estimates or what have you with the state of New York, because we know that our intent was always to return here. So even if we've been in Rhode Island or Georgia or what have you, then we need to be ready to file a full year New York state tax return. And all of your income from across the country will be taxable in the state of New York. Okay. because that's your domicile state. Even if you're earning your income in Georgia, if your intent is to return, then you will file 2 tax returns, a return for Georgia and a return for New York. Now, New York will be taxing that income that Georgia is also taxing, so you will be potentially subject to double taxation, which means instead of paying 10% to New York, you would be paying 10% plus your Georgia tax rate of, say, 5% to 15%. We're not big fans of double taxation in the United States. We're not fans of taxation at all in the United States. I think that's why we exist as a country at this point, if I remember correctly. So there are what's called state tax credits, wherein the state, New York State will give you a credit for the taxes paid to another state if it was subject to double taxation. And I'm going to show you what that looks like in a bit. So it'll help with the comprehension there. Cool. One thing that we get a lot of questions about is people mechanically say, well, I was a non-resident from March to September of the city, for example, so I would like to file as a non-resident for that period of time, for the 6 months in the middle of the year. That's what this last bullet point is here. And that's unfortunately not available, because you cannot be, according to the rules that we discussed, a non-resident for the middle of the year. Because, well, yes, you weren't there. The way that the tax law works is that you did return. So obviously your intent might not have been to return in the moment, but you did ultimately return to that jurisdiction. So we read that to make things simple as your intent was always to come back. You're a full year resident, essentially. If you did not land somewhere else, then you are a resident of that jurisdiction for the whole year. So that is not a type of return that we can file. All right, I've been talking a lot, so here's a little meme break in the middle. So we've established AJ is a big fan of Lord of the Rings, as are hopefully all of you. I believe this is the shot. This is in Mordor, right? Towards the end in the Return of the King, I think was the 3rd movie.
Yeah.
Cool. So, all right. So we've, what do we need to do if we have established residency in another place? For those of you that pay estimates, you need to, because you've got business income, you need to pay your estimates to the new state. You usually have an accountant that knows how estimates work. So I'm going to let you talk to your accountant or your advisor about paying estimates. We're going to focus on withholding for now, because it's a little bit more difficult or a little bit stranger. If you do think that you are going to be living in your new state or you're not returning, then you do need to update your withholding, okay? Because if you don't, let's use New York and Vermont as an example. If you have moved to Vermont and you're going to file a return with a part year, half the year, let's say New York, and then half the year Vermont, and you never update your withholding, you don't ever tell HR, they are going to withhold income for the whole year in the state of New York and none for Vermont. And you could end up in a situation where you go to file your tax returns, you don't have as much income taxable in New York as you thought. More of it is taxable in Vermont. So you would have a large refund from the state of New York, which sounds great, but you're going to have a large balance due to the state of Vermont because you didn't prepay any of your tax to Vermont throughout the year. So large refunds sound great, but the refunds usually come 4 to 6 weeks after you file your return, and the balances due are immediate. So you're going to have a bit of a cash flow issue there. So please tell HR if you plan on staying in your new location, you need to update your withholding. Each state has its own withholding form. New York's is the 2104. I don't know what Vermont's is off the top of my head, but just let HR know. They should be able to help you out. Now, we've gotten questions around paying capital gains in a New York, in a new state as well, and how to deal with that. At the federal rates, capital gains are taxed at preferential rates. So even if you're in like the 37% bracket, federal level, you would only pay 20% on capital gains. Most states don't recognize that special tax treatment. A lot of people don't know, but the federal IRS Internal Revenue Code is separate from all the states' codes. Each state has its own code. Fun, right? More complications for us all. And they don't recognize the preferential treatment that the feds do. So you're just going to pay them most of the time at the regular tax rates. We see our New York State income tax rates here, and as you move through these levels of income, if you're single, these are the brackets you'll end up in. Here's that 8.8 we saw on an earlier slide. New York City. So if you're trying to avoid state tax or capital gains in a state that is a higher bracket, just don't sell your shares or what have you until you move to the new state. And you can prove without a shadow of a doubt that you have changed domicile at that point in time via the things that we discussed earlier. And that'll help you avoid capital gains in an earlier, higher tax jurisdiction. All right.
Just a quick note there. For our equity compensation clients, this becomes a very important discussion, because we're talking about moving capital gains. We're talking about moving, millions of dollars at a certain time period. And, we don't tell you to move to another state, but if you are thinking about moving to a state like Texas or Washington, because you want to live in Austin or Seattle, those years when you're ready to sell that position, that's generally a good time to pack up and leave. So I've had conversations with a lot of you about that. And for those new folks joining us, that is something that we definitely want to keep in mind when you're making a big stock sale is, well, if I was going to move anyway, I might as well do it during the time when I'm ready to make this big sale so I can escape this extra 8% or 7%.
Yeah, there's a way to move states for tax reasons. It happens all the time. One other thing that is not in here for our California residents or soon to be former residents, California is one of the most aggressive about not letting income go if it was earned in California. And their definition of earned, they have these clawback rules where, for our equity comp people, again, like AJ was saying, if your options vested in the state of California and then you move states and sell them, wherever they vested is where California wants to throw that income back into the state. So there are scenarios where you say, lived in Silicon Valley for 2 years, you moved to Texas, 2 years later, there were options vesting while you were in California, and then you try to sell them while you're living in Texas. California does have a claim to those. Most people don't know that. Most people don't voluntarily look that up and remind themselves to go back and pay the state of California. The compliance is, probably at a low rate percentage-wise. People saying, yeah, I forgot I need to pay that tax back to California. But they do have a claim to it. So if you want to be on the up and up, then you need to review that if you did have RSUs, ISOs, non-quals that vested while you were in California. Cool. So I told you about state tax credits. I just want to show a visual here. I want to use New York and Vermont as an example. Oftentimes people, like if you're a domiciliary of New York, but you're working in Vermont now, you need to be paying taxes to Vermont, but New York's going to tax them too, because they're going to tax your worldwide income actually, even if you have income from Russia or whatever, New York is going to tax it. Here's an example down here at the bottom. Let's say you're commuting into New York from Vermont, okay? Actually reverse what I just said. So if you're commuting into New York from Vermont, you can have a New York liability for the income that you earned in New York of $5,500, $5,400, and then the Vermont tax on that. So you're a domiciliary of Vermont. Let's say this is where you intend to live for the rest of your life. Your tax on that would be $4,600. That's the same income taxed twice. So the way tax credits work is that they permit you to take a credit up to the amount that was double taxed, okay? You would get all of your Vermont tax removed and you would pay the higher of the two. Unfortunately, if you're engaging with a high tax state, even if you live in a lower tax state, you will pay the higher of the two on any of the income that is double taxed. All right, and to show you, we're going to talk about the convenience rule here in a second, but the potential exposure, if you cannot avoid that, if you don't get that tax credit, is you would pay pure double tax, which is the worst case scenario, right? So in this case, you would pay the full $10,000 on the income, which would be a double whammy according to this clip art that we added in. There's an example here that we're not going to dig into too much. It's going to take too much time. But we did want to allow those of you that like to screen grab to go ahead and screen grab this if you want to work through the methodology on how that works in more detail. I'm going to give you about to the end of this sentence here to screen grab this if you would like to get your print screen button ready. All right, let's move forward. Okay, now we're going to talk about, we got a lot of questions about deductions for remote workers, a lot about home offices, right? We're all working from home, right? Sorry about this contraption. I'm not fixing that. I'm a renter. Can I take a home office deduction if I am an employee? We get this question all the time, even from non-COVID times. And if you are a W-2 employee, if you're withholding, if there are taxes withheld from your paycheck, you cannot take a home office deduction. It's not available. Don't triple check with me in an email. That's not an opportunity for you. However, if you are self-employed, you can take a home office deduction. Essentially, the area of your home that is exclusively used for business. So not the square footage where your bed is, where the sink is in the kitchen. You don't use that exclusively for business. Not the kitchen table, because I'm sure at least once during the year you have used that kitchen table for a meal. Then that area doesn't count. However, the desk area, this area in my room that I use exclusively for business, would count as the numerator, the denominator being the whole home, square footage of the whole home. That's the ratio of your rent, mortgage interest, real estate taxes, insurance, etc. There's not much of an etc. actually beyond those things that you can take as a deduction for your home office, okay? And for those of you that are curious how the math works on that in more detail, we do share an organizer with all of our tax clients every year on how to calculate that. If you have trouble with that, let us know. Cool. So that's the home office question. For partners in a partnership, you too can take the deduction. S-Corp owners need an accountable plan, which is more complicated than we're going to discuss in this meeting. All of our outsourced accounting clients, where essentially their outsourced CFO, we set those up for you so that we make sure that you take them. For partners in a partnership, you too can take a home office deduction. What you need to do is add an addendum to your partnership agreement that says that any expenses paid personally for business expenses. So I am personally paying rent for my home office related to Brooklyn FI. You need to have a clause in your contract that says that the business will not reimburse me for it, for me to take that as a deduction on my personal tax return. Is where that happens. It's called an unreimbursed partner expense, and it can only happen if you've got this agreement, which apparently I have not signed yet.
Yes, both partners need to sign it, and I signed this a few weeks ago, and we're just awaiting your signature on that one, Shane.
Moving on, I've been talking a lot. I'm gonna let Emily take this slide. This is a fun. I'm playing good cop, bad cop here. The convenience rule is a bad cop situation.
Yeah, I'm bad cop. So I just want to further on this rule because it contradicts what Shane said about credits. The convenience rule was actually put in place before the pandemic, so it's not a pandemic era litigation. 7 states recognize it now. 6 previously did. It was Arkansas, Connecticut, Delaware, Nebraska, New York, and Pennsylvania. I believe Massachusetts is the new state that just implemented the convenience rule, which is a little worrisome because it basically enables double taxation. So as Shane kind of touched on, if you're living in New York but working in Vermont, you're going to get taxed in both states, and New York is going to give you a credit because the work was done in Vermont. But because we're all working remotely, or because work can be done remotely, if you're in New York and you're working remote in New York is going to say you are in Vermont, so we're not going to give you that credit. You earned that income while you were working in New York. It's been litigated in the past unsuccessfully, actually, and there hasn't been much talk yet in Congress as to whether or not there are going to be some rules put in place to help with this issue, because it's not something that we want to see during the pandemic. And I think with that, that leaves us with Q&A.
That's right. And you know, if we don't understand any of the things, if anything can come across, at least you're aware of some of the principles of moving tax residency and the things you need to watch out for. We've given you the vocabulary to Google at this point. If You can also let us know if you have any questions in email format afterwards. But yes, we do have Q&A, AJ, or
yeah. Sure. Please drop them into the chat or into the Q&A box. We have one question, which is if we have further questions about being self-employed and weird stuff happening due to COVID this year, can we reach out to schedule a 10-minute chat with someone? If you are already a client, of course, you know, if you're a Brooklyn FI client, my inbox is always open, and we should definitely have a chat about that. If you're not currently a client, we can arrange for that. But generally, you know, we do these webinars to get out as much information as possible to the public. If you do have a specific question, drop us an email. We'll see if we can answer it that way. Does anyone else have any specific questions?
So I did so well, there's no questions. Amazing.
Oh my God. Guys, come on.
We had some pre-sent Q&A, but I think we kind of targeted our presentation around those questions, so hopefully they've all been answered.
Yeah, I'm going to grab one or two of those just to throw those out to Emily and Shane while we have you guys here, which is, let's find a good one here.
Well, I can further on that, AJ, because
yeah.
I think there was some like unclarity, I think, in regards to there was a question like, is it worth changing my tax residency if I still rent in Brooklyn? I own upstate and I've lived there the last 6 months. So while you might meet like the statutory requirements, right? Like let's say you've lived upstate for 7 months, you've been out of New York City for 7 months. So you're thinking technically I could file a part year New York City return because I meet the statutory requirements. New York is going to look at your intent, or New York City, and they're going to say, well, even though you were outside of New York City for 7 months, you came back here next year, you plan to come back here, you should have filed a full year New York City return. So that's something to look out for if you're outside of New York City or outside of New York State, or going back and forth between any state. Even if you don't meet the statutory requirements, they're gonna look at intent. And I think there's gonna be like a lot of audits taking place, because I think a lot of people are gonna think that they can file part year returns when they really plan to come back.
Yep, exactly.
And another thing that I'm not sure if our audience here is going to be dealing with, what we've been dealing with a lot recently is a case wherein we had someone coming to New York for a lot of work that didn't file any New York state returns. And the state of New York looked at the income that was earned for that individual at a federal level and assumed it was all earned in New York. So if you want to claim, you know, like one way to cover your ass essentially is to still file a return and only claim the amount of income that was actually earned in New York or New York City for that case. If you just go cold turkey and just disappear, don't file anything, the tax authorities do have the ability to just assume that all of your income was earned there unless you claim otherwise. So claiming otherwise is a great way to start the conversation, or really to anchor the conversation into what you have claimed and not let the tax authorities take the first punch, essentially.
Yep. There were also a few questions about, you know, deducting expenses, like what is deductible if you are in fact a contractor. I dropped a link to our expense organizer. That organizer we built off of what actually goes on the tax return. So if you want a good guideline to use throughout the year as to what is actually deductible, you can just use that. It's an Excel document that we have that you can download. You know, having that filled out throughout the year is a great way to do that, rather than waiting till the end of the year, digging through credit card expenses to kind of put together a hodgepodge of what you might have spent money on to do the work that you need to do. So there were some questions about that. Yeah, computer monitors, laptops, things like that that you need to do work on. Certainly deductible expenses if you are an independent contractor. You know, we could potentially see some law changes because there's so many people working from home. You know, before the tax reform in 2018, there were provisions to deduct expenses as a worker, right? You know, if you had a uniform you had to buy, you know, like you could deduct your scrubs if you were, you know, an assistant in a hospital or a doctor. That went away. So if you happen to be Googling and you find something that says you can deduct employee expenses, you're probably reading a website or a blog from 2015 or something like that. So that we did have that, it went away. We don't have any laws on the books now or any proposals, but we could potentially see that happen for tax year 2020.
Yeah. And here's the convenience rule too. Like there are already like congressional like introductions as to how like they can avoid the double taxation. So that will hopefully be something that will be addressed. There just hasn't been a lot of discussion around it right now, which is kind of alarming, especially with Massachusetts just adding the convenience rule. But I would assume if states continue to do so, that Congress will address it. And they do have like the means and some legislation that's already been introduced to address it, which is good.
Excellent. We do have one question that came through, which is, can you talk a bit about how virtual partnerships, doing business with businesses in other states and having to pay taxes in those states, or partners having to pay taxes in those states, like paying to New York when you live in Illinois and the partnership address is in Illinois?
Totally. So what we're looking at here is this. This presentation was a little bit definitely focused on employees and essentially employees and independent contractors. So this is about a partner worrying about allocating income because she owns a business that operates in multiple states. So the technical term for the necessity to file in another state is called Nexus. And there's, you might trigger Nexus if you meet certain thresholds. Like if you just drove through a state one time and made a phone call to some of your clients, does that trigger Nexus because you were working in that state? Well, the three things that go into Nexus typically in order of importance are the sales and for the revenue that you generate from each state. So if you're in Illinois and you've got some clients in New York, you could potentially trigger Nexus in the state of New York. Depending on if the income is high enough, you might want to allocate some of your income there. Or if you're visiting more often, it's more likely the case if you're going to New York to do those meetings IRL, that would have a higher chance of triggering the sales issue, like where you're generating that income, as opposed to working virtually. You can argue that you are, and each state again is different on how they define Nexus, unfortunately. The second thing is where your employees are, if you have employees, or where your partners are. If you've got one partner in Illinois, but your other partner's in New York, then you're going to be allocating income to New York, unfortunately. We will definitely be allocating income. Our partnership will be allocating income to California this year because AJ has been living there for months and months and months. So we need to allocate some income there. Otherwise, California comes at you if they find out.
8 weeks.
Wow. That's 2 months. Months and months.
2 months. That's months. It's months. It's not months and months. And
all
months.
Right. So, and then if you have employees or partners, so we also have an employee in Illinois. So we will be allocating income to Illinois. It's Emily here. It's in Illinois. We have some in Delaware as well. And the third thing is where you have offices, right? So your overhead. So some states use all three of those things. Some states just use what they call a single sales factor. And even if you do have sales to a certain state, you might not even need to file there. For example, we were working on a partnership return earlier today where $1,200 of income was allocated to Massachusetts for this sports agent that we work with. And Massachusetts says you don't even need to file here unless you have 8,000 or more. So unfortunately, it's on a state-by-state basis. And you can, if you want to look at state nexus issues, you need to Google that. You need to Google Nexus Massachusetts. Or you can look at the instructions for, say, a partnership tax return for Massachusetts or whatever state that you're looking at potentially filing in. You got it, Andrea.
Anything else? Any final words from Shane or Emily? Nope. Cool. So this was this is our fifth webinar this year. We are trying to digest changes to tax law, and as the world changes, we're trying to get information as we understand it out to our clients and the wider community. So thanks so much for attending. This was recorded, so we'll post this on our website in the next week. That's brooklynfitax.com. We actually have a bunch more webinars coming up.
Monthly, right?
What's that?
Monthly?
They're going to be monthly. The next one is a very exciting webinar. It is going to be on Thursday, September 24th. And that webinar is titled Year-End Tax Planning Strategies for Individuals. We are going to be meeting with all of our ongoing clients to do our year-end tax planning meeting. We're going to cover some of the more basic strategies in that webinar. So if you have any, friends or colleagues who don't have financial planners yet, that's definitely going to be a great one to check out. So that's brooklynfitax.com/events.
Take care.
Ciao.